Let's review chapters 7 through 9. Our first question here says Smith Company has a balance in its accounts receivable control account of $10,000 on January 1st. The subsidiary ledger contains three accounts. Bixler Company has a balance of $4,000, Kadire Company has a balance of $2,500, and then there's Freeze Company that we don't know the balance for yet. During January, the following receivables-related transactions occurred. So we're given credit sales, collections, and return information for each Bixler, Kadire, and Freeze. So the first part of this problem is figuring out the January 1st balance in the Freeze Company subsidiary ledger. So the way that we're going to do this is the sum of all of our subsidiaries need to equal the control account. So we're given two of our subsidiaries. We're given the Bixler and the Kadire balances, and then we're given the balance in our accounts receivable control account. So 4,000 plus 2,500 plus Freeze equals $10,000. We clean that up a bit, and we can see then that Freeze will equal our 10,000 minus the 6,500, which will give us this $3,500. So we're just using algebra here to solve for our unknown balance for the Freeze Company subsidiary ledger at the start of the month. Then, what is the January 31st balance in the control account? So the control account, that's the overall accounts receivable account, right? So that one started off with $10,000. During January, we had these credit sales, collections, and returns, right? Since we're dealing with the control account, we're going to want to sum up each of those groups. So we sum up all of our credit sales, and we get 24,500. We sum up all of our collections, we get 19,500. And then our returns, just that $3,000. Now that we have that information, we can work on figuring out the January 31st balance for accounts receivable, for the control account. We're going to use this equation. It's our beginning balance plus credit sales, because if we were to make a credit sale, that would increase our accounts receivable, minus collections, because whenever we collect money from someone, our accounts receivable decreases, and then minus returns, because if a customer returns something to us, our accounts receivable balance would decrease as well. So we work through all of that, and we'll be able to find the January 31st balance. So January 1st, we started off with 10,000. We add in our credit sales that we found to be 24,500. Subtract out our collections, and subtract out our returns, and that will give us our January 31st balance. So that comes out to be $12,000. So at the end of the month, after all of these transactions, accounts receivable has a balance of $12,000. Now, we need to compute the balance in each of the subsidiaries at the end of the month. So we're going to start here with Bixler. And we're given the information about what happens during the month with Bixler, right? The $9,000 in credit sales, the $8,000 in collections, and they didn't make any returns. But we're going to follow this same setup that we just did for the control account, where we take our beginning balance plus the credit sales minus the collections minus the returns. So we were told at the start of the problem that the January 1st balance for Bixler was $4,000. Then we want to add in our credit sales that were given at that table up above, subtract out our collections, and minus 0 for our returns. And we can see that the January 31st balance will be $5,000. So now let's move on to Kadire. Once again, we're going to follow the same steps. Kadire started off with a balance of $2,500. We add in the $7,000 in credit sales because when we make a credit sale, our accounts receivable is increasing. Then we subtract out the $2,500 that we collected from them and subtract out the $3,000 in returns that they made to find their January 31st balance to be $4,000. Now for Freeze Company, we found that the January 1st balance for Freeze was that $3,500. We add in the credit sales, subtract out the returns and the collections, and the January 31st balance for Freeze Company will come out to be $3,000. So we have all of our balances over here in this table, right? Bixler owes us $5,000, Kadir owes us $4,000, and Freeze owes us $3,000. Those all add up to $12,000. Now, where did we see that $12,000 before? That's the balance in your control account, right? So the balance in your control account will equal the sum of all of your subsidiary ledgers, right? When we add up Bixler, Kadir, and Freeze, those all add up to the balance in the control account. Let's move on to question number 2. So question 2 is dealing with special journals. So we're going to be given a list of transactions, and we need to figure out if it goes in the sales journal, cash receipts, cash payments, single column purchases journal, or if it just falls into the general journal. So before we go through those transactions, let's just talk about what goes into which journals. So the sales journal, that's going to be any time that you sell merchandise on account. So not only just sales on account, but it must be sales of merchandise on account. Cash receipts journal, that's just any time that you get cash. So if we're dealing with a transaction where we are receiving cash, we know to throw that into the cash receipts journal. Same kind of idea here for cash payments journal. That's any time that we pay cash. So if we are crediting cash in our journal entry, that would fall under the cash payments journal. The single column purchases journal is going to be any purchases of merchandise on account. And once again, not just any purchases on account, it must be purchases of merchandise on account. And then your general journal is going to be the spot where you put your adjusting entries, closing entries, and correcting entries. So we can use that information to help us figure out which journal to put each of these transactions. So this first one here, payment of creditors on account. So we are making a payment to people that we owe, so that's our cash payments journal. Collection on account from customers. Well, what are we collecting from our customers? We're collecting cash, right? So if we are getting cash, that falls into the cash receipts journal. Sale of land for cash. So the first thought here might be sales journal, right? Because there's a sale. But remember, your sales journal only involves sales of merchandise on account. Here we're selling land and it's for cash, so we can cross off the sales journal. But when we see that cash is involved, we can be thinking either cash receipts or cash payments. If we are getting the cash, it'll be cash receipts. If we are paying the cash, it'll be cash payments. So if we sell land for cash, we are receiving cash in this transaction, so it'll fall into the cash receipts journal. Now the sale of merchandise on account, we just talked about that. That's the definition of what falls into the sales journal. Sale of merchandise for cash, well now all of a sudden it's not on account, right? And cash is involved. And we are receiving cash, so it's going to go into the cash receipts journal. Now a tricky one here, sales discount taken on goods sold. So we need to think about the transaction that's happening when this sales discount is being taken. We see that it falls into the cash receipts journal because you record a sales discount on the day that you receive payment. So that sales discount transaction corresponds with debiting your cash a certain amount as well. So that's why this is going to fall into the cash receipts journal. Now, payment of employee wages. Well, how do you want to pay your employees? That's going to be with cash. So that falls under the cash payments journal. Now, income summary, close to owner's capital. That's one of your closing entries. And closing entries are recorded in the general journal. Depreciation on a building. Whenever we record depreciation, that's an adjusting entry. And adjusting entries go into the general journal. Now, the purchase of office supplies for cash. We might be thinking purchases journal off the bat, right? Because we see the word purchase. But here, it's not on account and it's not dealing with merchandise. So we can toss aside the idea that it will go into the purchases journal. Instead, we see that it's involving cash. And if we're making a cash purchase, we know that we are the one having to pay the cash. So this goes into the cash payments journal. Then purchase of merchandise on account. That's the definition of what falls into the single column purchases journal. Question number 3 says Newport Company uses a petty cash system, and we need to prepare the journal entries for the following dates. So the fund was established on March 1st with a balance of $100. And then on March 15th, with $2 in cash remaining in the petty cash fund, the fund was replenished. The following petty cash receipts were found in the petty cash box. There were $39 for stamp inventory, $21 for freight out, $11 for miscellaneous expenses, and $24 for travel expenses. So on that day, we are recording all of these receipts that we found, and then also replenishing this petty cash fund. And then a few days later, on March 20th, we want to increase the amount in the fund to $175. So first, on March 1st, when we are establishing the petty cash fund, your journal entry will include a debit to petty cash and a credit to cash. Whenever we establish a petty cash fund, that's what your journal entry will look like. Now, on March 15th, this is when we wanted to replenish the petty cash fund, right? So what we're going to do is we're going to first debit all of our expenses. So we had receipts in that petty cash fund for stamp inventory, right? So we're going to call that postage expense. And then we had some receipts in there for freight out, miscellaneous expenses, and travel expenses. So we debit each of those, and we toss in the amounts into the debit column. Then we're replenishing this petty cash fund, right? So we're putting cash back into it. And how much cash do we need to show that our cash is decreasing here? It's 98. We get this 98 because we were told that your petty cash fund had $2 remaining. So initially there was going to be $100 in there. But then we only have 2 left. So that means that our cash went down $98. Now, if you add up your debits and your credits here, you'll notice that they don't equal. Ideally, they would, right? Ideally, the receipts that we found in our petty cash fund would equal the amount that our cash decreased by. Sometimes that's not how it works. So when they don't equal, we have this account called cash over and short. And this account just deals with any sort of extra cash that we had or missing cash that we had. Well, in this case, we had some missing cash. If you add up your debits, it's less than $98, right? So we put that extra 3 over on the debit side to make our debits and credits equal. And we're going to debit this account called cash over and short. Now, on March 20th, we wanted to increase the petty cash fund to $175. This is going to look pretty similar to the first entry that we did when we established this petty cash fund. We debit petty cash and we credit cash. The key here is to look at the numbers. Our petty cash fund is now up at $175. But we only have to debit petty cash here for 75 because we were already at 100 after our first journal entry. So whenever we increase our petty cash fund, we need to record that entry for the amount that we are increasing it by, not the amount that we are increasing it to, but instead that gap between the 100 and the 175. So that's why we're recording this entry for $75. Now, question number 4. It says to prepare a bank reconciliation at July 31st. Then journalize the adjusting entries on July 31st on the books of Crane Video Company. The following information pertains to Crane Video Company. So we're given 6 pieces of information here. We're given cash balance per bank, a July bank service charge, cash balance per books, deposits in transit, a collection of a note, and some outstanding checks. So we can use all of this information to prepare this bank reconciliation. So let's first look at the per bank side of this bank reconciliation. We're going to start off with the cash balance per bank. So this is looking on the bank statement. It tells us that we have $7,263. So once we include that, we can cross that off of our list because we won't need to be using that again. Now, there's certain things that will be added and certain things that will be subtracted here on a bank reconciliation. When we're dealing on the per bank side, we need to be thinking, what are some things that the bank doesn't know about? So the first thing that we're going to add here are the deposits in transit. Us as the company, we know about these deposits. We've already recorded them, but they're in transit. They haven't made it to the bank yet. But once they do make it to the bank, it's going to increase your balance. So that's why we add it under the per bank side in a bank reconciliation. And then what are we going to subtract? Going to subtract outstanding checks. Because once again, from the company's perspective, the company knows that they've written these checks. The bank has no idea, right? An outstanding check is just when you write a check and you hand it to someone else. In your mind, in the company's mind, you don't have that money anymore. But there's no way for the bank to know that you wrote on a check, that you wrote on a piece of paper to pay someone until they take it to their bank. And that time from when you write it to when the person that you wrote it to takes it to their bank, in that time gap, that's an outstanding check. It's still out there in the world. Right, so we have our adjustments here over on the per bank side. There's one last step that we need to do. We need to find the adjusted cash balance per bank. So we'll take our cash balance per bank that we were given on our bank statement of $72.63, add in our deposits in transit, subtract out our outstanding checks, and we get an adjusted cash balance per bank of $79.72. And we'll keep that number in mind as we move over onto the per book side. So the per book side is going to start off in a similar way. We start off with the cash balance per books. So this is what we see in our ledger, in our T accounts for cash, right? According to us, we have $7,284 in cash. But there's some things that will be affected here that the company maybe didn't know about, right? So what are we going to add? Well, we can take a look at the two pieces of information that we have left. We have a bank service charge and we have the bank collecting a note for us. Well, a bank service charge is going to take money away from us, right? So we don't want to add that. Instead, we're going to add this note that was collected by the bank. Because the bank is acting as like a middleman here, and they're collecting this money for us. So we take a look at the information given to us. It says bank collected a $700 note plus interest of $36 less a fee of $20. So we need to figure out how much money we actually got here. So we take the face value of the note, add in the interest, subtract out the fee, and we see that we collected $716 in cash. So that $716 is what we are going to record on our bank reconciliation. Then what gets subtracted? Well, that's that bank service charge, right? Because that's going to take money away from us because we have to pay the bank this $28. Now we can find our adjusted cash balance per books. We start off with our cash balance per books that we had in our ledger of $72.84, add in the note collected by the bank of $716, subtract out our bank service charge of $28, and we get an adjusted cash balance per books of $79.72. Now, I said we were going to keep that number in mind, right? Because your bank reconciliation is to make your adjusted cash balance per bank and your adjusted cash balance per books equal. Because you have a definitive amount of money. So the balance that the bank says that you have and the balance that your books say that you have, those need to equal. Here, they do, so we know that we work through this bank reconciliation correctly. Now, there's some journal entries that go along with this bank reconciliation. Anything that's over on the per books side, you're going to need to prepare journal entries for. So we had first the bank collected a note, and then we also had that bank service charge, right? So those are the two adjusting entries that we will need to prepare here in this example problem. So let's first work on the bank collected a $700 note for Crane in July, plus that interest of $36, less the fee of $20. How are we going to work through this? Well, we know that they collected a note for us. So we can credit our notes receivable because our notes receivable would be decreasing after they collected this note. There's this interest. We're making money with this interest, right? So it's going to be interest revenue. That's going to be a credit as well because revenues go up with credits. Then we have this fee. Whenever we see a bank fee, we're going to record that as a miscellaneous expense. So we'll debit our miscellaneous expense. And then we have cash. Because every single bank reconciliation journal entry is going to involve cash. Because it's all about your cash balances, right? So we debit our cash because our cash is increasing here with the bank collecting this note. So now we can talk about the numbers. Notes receivable, that's the face value of the note of $700. Interest revenue, we were told that was $36. The fee was $20. And now our cash, there's a few different ways that we can figure this one out. We know that our debits and credits have to equal in a journal entry, right? So we can think about, okay, what do we need to add over to the debit side to make our debits and credits equal? That's one way. Another way is that the cash amount in these entries will always be the amount that you have on your bank reconciliation itself. So on the bank reconciliation that we prepared, under collection of note, we put 716, right? Because all we did was we took the face value plus the interest revenue minus the fee. So there's a few different ways that we could have found that 716 there. Now this bank service charge. So there was a service charge of $28, but we hadn't recorded it yet, right? So once again, this is one of these bank fees. So we will debit our miscellaneous expense. And here, our cash was decreasing, so we credit our cash, and we just toss in that $28 that we see for the fee. Now question 5. FAR Company elects to use the percentage of sales basis in 2019 to record bad debt expense. It estimates that 2% of net sales will be uncollectible. Sales revenue for 2019 is $800,000. Sales returns and allowances are $40,000. And allowance for doubtful accounts has a credit balance of $9,000. We need to prepare the adjusting entry to record the bad debt expense in 2019. So before we can work through that adjusting entry, we need to figure out the estimated amount that will become uncollectible, right? So that's 2% of net sales. So we need to find our net sales. So your net sales will be your sales revenue minus your returns and allowances in this case, right? So 800,000 minus our 40,000 gives us our net sales amount of $760,000. That's step 1. Now, with that information, we can see that 2% of net sales will become uncollectible. So we take our net sales amount times 0.02, and we see that 2% of net sales is $15,200. Now, there was one extra piece of information that was given to us, right? This allowance for doubtful accounts. Whenever we are working through the percentage of sales basis, like we are here, we don't care about that allowance for doubtful accounts. We only care about the allowance for doubtful accounts balance when we are working through the percentage of receivables basis. So that $15,200 that we found, we're going to use that amount in our journal entry. So whenever you estimate uncollectible amounts, whether it's percentage of sales or percentage of receivables, we will be debiting bad debt expense and crediting allowance for doubtful accounts. Right? So bad debt expense, that's an expense account. So that's going up with this debit. And allowance for doubtful accounts, that's a contra asset. Just like how back in chapter 3, we were learning about accumulated depreciation, right? And that was a contra asset. Well, allowance for doubtful accounts is another contra asset. So this is going up with this credit. And we just toss in that $15,200 that we found. Now, Kingston Company uses percentage of receivables basis to record bad debt expense. It estimates that 1% of accounts receivable will become uncollectible. Accounts receivable are $420,000 at the end of the year, and allowance for doubtful accounts has a credit balance of $1,500. We need to prepare the adjusting entry to record the bad debt expense for the year. So, under the percentage of receivables basis, we do care about that $1,500 credit balance for allowance for doubtful accounts. So we'll see when that comes into play here. But first, we need to figure out 1% of accounts receivable. So we take our accounts receivable amount of $420,000 times 0.01, and we see that 1% of accounts receivable is $4,200. So let's make a T account for our allowance for doubtful accounts now. It starts off with a $1,500 credit balance. We just found, with that 1% of accounts receivable, that we want our allowance for doubtful accounts to end with a credit balance of $4,200. This entry that we're going to be making here is to get us from $1,500 on the credit side to $4,200 on the credit side. What would that amount be, right? So when they're both on the same side like this, we can just subtract the two amounts. And when you take 4,200 minus 1,500, you'll get that 2,700. So that's what we're going to be recording in this entry. Once again, we debit our bad debt expense and we credit allowance for doubtful accounts. That doesn't change just because we're doing percentage of receivables. What changes is our number, right? So it's not just the 1% that we found. It's the 2,700 that we need to credit allowance for doubtful accounts for to bring that account balance up to the 4,200. Now, let's switch things up a little bit. Everything's the same except for this allowance for doubtful accounts balance. Instead of having a credit balance of 1,500, it now has a debit balance of 800. So once again, the 1% of accounts receivable we see over on the left side of the screen, still 4,200. But we make another T account for our allowance for doubtful accounts. And this time we're starting off with a debit balance of 800. But we still want to end with a credit balance of 4,200. So we're going to need to credit something to bring us from that debit balance over to a credit balance, right? And when they're on opposite sides like this, we can add them together, and we see that we need to credit $5,000 to allowance for doubtful accounts in order to take us from that beginning balance of 800 on the debit side to an ending balance of 4,200 on the credit side. So we prepare our journal entry. Once again, debit your bad debt expense and credit your allowance for doubtful accounts, and we'll toss in the $5,000 as our amounts.